Welcome to the second video lecture of session 6. In this lecture, we learn about different decisions that firms take while making an entry decision into a foreign economy. A firm making foreign investments faces four key decision problems. First, where to enter, that is, which countries or regions to select for investments and operations. Second, when to enter, that is, what should be the timing of entry. Third, what should be the scale of investment? That is, the level of the strategy commitment to the country or region. And the fourth, how to enter, that is, what should be the mode of entry? For instance, whether the firm should create a subsidiary from the scratch or it should acquire an existing organization in the foreign country. Let us first understand how firms decide which economies to enter. Some scholars have written about a systematic approach to market selection, which is more normative. That is, it tells us how a firm should select a foreign market for investment. So the first step is to determine why the firm is going to a foreign economy. For instance, is it looking for market? Is it looking for efficiency? Or it is after certain strategic resources or inputs? Or it wants to save taxes, etc. Then the firm should identify its choice criteria. For example, there can be certain country-specific indicators such as macroeconomic conditions, political stability, institutional and cultural characteristics, etc. And market-specific indicators such as market size, cost of production, and intensity of competition in the factor and product markets. The firm may prioritize the criteria, assigning different weights to them. The firm should generate alternatives, a list of countries where it could make the FDI and rate each country alternative on each criteria. While computing the optimal decision, a firm can use different models. For example, it can choose an economy which scores high on one criterion or the other. Suppose a firm decides to invest in an economy that either has low cost of production or which gives high subsidies or tax rebates. Some criteria are not substitutable. For example, tax rebate or subsidies cannot compensate for political instability and state fragility. The firm can also choose threshold for certain criteria. So any economy that doesn't pass the threshold in each criterion will be eliminated. For example, if a firm is seeking long-term growth, it may decide to keep a certain threshold along three criteria. One, market size in terms of value and volume. Second, market growth rate, which tells us about future potential. And third, political stability. Any economy that doesn't meet the threshold on either criteria, any one of these three, will not be selected for entry. Well, scholars have underlined that firms often don't make market selection in a very systematic manner. Decision makers have incomplete information and limited information processing capacity, which makes systematic approach rather impractical. So behavioral scientists suggest that managers take satisfactory or good enough decisions rather than optimal decisions. So internationalizing process is incremental as also suggested by Uppsala model. Managers avoid uncertainty and increase their stakes gradually as they understand the economy more. So these scholars argue that managers rely heavily on experiential knowledge in making decisions about entry and early expansion. It has been observed that some firms enter and expand in foreign markets opportunistically. So a firm gets unsolicited orders from the buyers or customers in a country. Once it has created a network in the market and its operations are profitable, the firm increases its commitment and expands its operations. Thus, decision-making about entry is marked by incomplete information and bounded rationality. By boundedly rational decisions, we mean that the managers take rational decisions but in a very myopic way. They keep short-term goals in mind and operate with limited information. The theory of relationship-based entry is highly relevant in industrial marketing, especially in the countries with high environmental and behavioral uncertainty. For example, you don't know how your customer or how your collaborator or how your suppliers are going to behave. Here, the entering firm seeks information about how compatible are its goals with its partners, how much it can trust them, and how its performance is in the market. Now let me list some of the factors that affect firms' market selection choices. The first is cross-country distance between the home and the host country of the firm. If a foreign market is geographically proximate and it is culturally and institutionally similar with similar levels of economic development, the firm is more likely to enter that market. This is because the firm will not have to make so many adaptations and it understands the culture, it understands the country, the market, right? The second most important factor is social and political instability and policy uncertainties. So firms hesitate from investing and operating in countries or economies which experience social unrest and political instability and lawlessness. So that is why you will see that companies hesitate from going into war zones or where there is civil war, some kind of strife, revolts, revolutions, right? And policy uncertainty can also slow investment decisions. A classic case here is UK after Brexit decision, right? So third, the macroeconomic conditions. For instance, GDP growth, industry growth, stable exchange rates, and low input costs. All these things attract foreign investments. Last but not the least, options value of the subsidiary. So let me explain this to you. So if a firm can reduce its overall risk under uncertain conditions by investing in an economy, the firm is more likely to make an investment. Let me give you an example. Imagine that a US-based MNC has a manufacturing unit in China where it gets the lowest costs. Should it invest in another country which is not highly integrated with the Chinese economy? That means if something happens to China, if the wages rise in China, it doesn't, increase the wages in that country. Or if something wrong goes in China, it doesn't affect so much the other economy. Hmm? Imagine that the firm created a manufacturing unit in Poland as well. Poland is very different from China, so that if any politico-economic or social or natural reasons, for example, pandemic, right, for whatever reason, the supply in one of the country is negatively affected, the firm should survive. So if something happens in China, at least you have a manufacturing unit in Poland, or something happens in Poland, you have at least one manufacturing unit in China. And these two economies are not very closely integrated. These are not the German economy and French economy or German economy and Italian economy, which are because of EU. These two countries are institutionally very strongly integrated, right? Common market. Okay. So recently, if you see, US slapped higher tariffs over Chinese imports. So now the firm can shift because now the cost suddenly increased and it has to market its products in the US. So the firm can shift its production from China to Poland. So for instance, if it was producing 100 units in China and 20 units in Poland, is likely to expand the manufacturing unit in Poland and make it like 70 and reduce this production in China from 100 to let's say 50, right? So there's a country which can provide firms options value is more likely to attract FDI. Now let us see the second question. When should a firm enter in an economy? Should it be one of the first firms to enter in that economy and gain first mover advantage? Or it should enter at a later stage when other foreign firms have already entered and expanded in the market? Let us see the advantages and disadvantages of early entry. The first advantage is that the firm preempts its rivals. It can create a strong brand image, build sales volume, and scale economies. It can be ahead in the learning and experience curves, and therefore will have lower costs. The firm has an opportunity to lock in the clients and the suppliers, especially if their cost of switching is very high. Now, there are certain disadvantages as well. The first is the cost of promoting or establishing a new product in the market, especially if the firm is introducing an innovative product in that market. That means that market did not pre-exist, that product category did not pre-exist. It will have to bear the cost of market creation from product introduction to customer education. At the end, the firm doesn't have the benefit of learning from the decision of other foreign firms. So see, firms face a liability of foreignness because they are not embedded in the local culture, business networks, and institutions in the host country. They suffer from lower performance. They can overcome this liability of foreignness by learning about the local context, about the culture, about the people, about the network, about the institutions, how the law works, etc., etc. A firm can have own experiential learning. That means whatever it experiences, it learns from own decisions. So it takes various decisions and sees which one works, which one fails, right? And the second is the vicarious learning. That is learning from the decision of other foreign firms, other peers, right? So if I'm a Japanese firm in the UK market, I learn not only from what works, what decisions I have taken, but also the other Japanese firm in the industry have taken, right? So if it is an early entrant, let us say my firm is early entrant, it doesn't have an opportunity to learn from other firms because they did not exist. So there is no universal answer because there are advantages as well as disadvantages. So it depends on the case, on firm, on the market, on the competitive situation. So on the strategic objective of the firm. So yeah. Now let us come to the third major decision issue. What should be firm's scale of entry in the economy? This decision depends on firm's strategic commitment to the economy. If a British firm considers the US as a strategically important market or supplier base, it is likely to make a large investment. To give you another example, Japanese pharmaceutical company Daiichi Sankyo considered India one of the high growth markets with strong future potential. So it entered the market by buying majority stakes in Ranbaxy, which was the largest drug manufacturer in India at that time. Large entry has its own pros and cons. First of all, collaborators, customers, and other stakeholders in the host economy, everyone takes you more seriously and positively. They think that you are here for a long term and consider the economy strategically important. Large entry also means economy of scale and lower costs. If the firm has entered early, it can reap the benefits of first mover advantage more effectively with a large investment. However, large entry attracts the attention of existing firms as well. As the entrant firm poses a threat to them, they are likely to give strong competitive responses. For instance, they can wage price wars or go for intense promotional wars. Normally, large-scale entries change market structure in the host economy and increases the intensity of competition. So it makes the market less attractive for other potential entrants. However, it also signals country-specific advantages of the economy and can induce entries from the global rivals of the entering firm. Further, large investment means high cost of exit. So if such a firm fails in the foreign market, it fails really big. At the end, let us look at the opportunity cost. If a firm has invested a huge amount of its resources in one economy, it has fewer resources to invest in other economies. Firms can operate in foreign economies either entering into market relationships or by making an investment. There are four modes of market entry through investment. If the firm creates a new organization with 100% ownership, it is called as a wholly owned greenfield subsidiary. If the firm creates a new organization in equity partnership with another firm, it is called an international joint venture. Alternatively, the firm can wholly or partially acquire an existing organization. So now let us see pros and cons of each mode of entry. Let me first of all list the advantages of entering foreign markets by making greenfield investments. So a greenfield unit is designed to fit the strategy and the organization of the parent firm, which enjoys a complete strategic and operational control over such a subsidiary. Strategic control means that the firm determines the scope of the subsidiary, what it is going to do. Will it do R&D? Will it do production, sourcing, assembly, export, marketing, or provide services, or does a combination of these? Operational control implies that the parent firm designs how the subsidiary will do what it aims to do. That is, the parent firm designs the processes and operations in the subsidiary. Next, because the firm doesn't share ownership with the local partners, its knowledge resources and intellectual property are protected. Moreover, it has relatively more freedom to expand or limit its operations as per requirement. Now let us look at the disadvantages. Greenfield investments add to the total supply in the market. So it increases the intensity of competition and lower the prices, thereby hurting profitability of even the entering firm. Therefore, you will see that in saturated markets, foreign firms often enter by acquiring existing organizations so that it doesn't add to the capacity and doesn't lead to oversupply. Compared to acquisitions, greenfield investment is a slower mode of entry. Now let us list the risks. Greenfield investments have longer payback periods, so there are higher investment risks. However, the parent firm doesn't face integration risk as in case of acquisitions. There are no co-owners, so there are few conflicts of interest, actually no conflict of interest. On the negative side, as there are no local co-owners, the firm faces stronger liability of foreignness. Now let us see some examples of greenfield investments. So Japanese automobile firms like Nissan, Honda, and Toyota entered UK, creating greenfield plants. These firms excel in market because of their capabilities or competencies in process and production engineering. If these firms acquired a pre-existing unit, they had to redesign the operations, which could be more complex and costly. Similarly, you will see that many IT and semiconductors firms like Intel, Google, and Microsoft established greenfield R&D and service centers in India. The greenfield investments protected their intellectual property and knowledge resources more effectively. Now let us look at firms' entry into foreign markets by a full acquisition of existing organizations. First, the advantages. Because the firm enjoys complete ownership over subsidiary, it has a total strategic and operational control. Its knowledge resources and intellectual property are protected. Acquisition is also a fast mode of entry because the firm gets an up and running organization from the first day of ownership. As the subsidiary doesn't add new capacity, entry through acquisition doesn't increase supply in the market. Now let us look at the disadvantages and risks. So acquisitions have high upfront capital investments. It is observed that when an asset has multiple bidders, the acquirer often ends up paying a premium. That is what we call a winner's curse. That means you're a winner because you bought this asset, but you're also cursed because you ended up paying a lot of premium. Acquisitions have high investment risks. An acquiring firm may face the problem of adverse selection. That is, the seller hides the information, negative information about the assets from the potential buyers. Entry through acquisition also poses the challenges of double acculturation. A firm entering a foreign market through acquisition of an existing organization has to adapt not only to a new national culture, but also to a new organizational culture. Now let us take the case of Tata and Chorus Steel. When Tata Steel entered the British and European market by acquiring Chorus, it had to adapt not only to the British culture and institutions, but also to the organizational norms and culture of Chorus Steel. All these factors increase the entering firm's likelihood of failure. Sometimes acquisitions can be politically sensitive, especially if the acquired firm is considered a national champion, or if the stakeholders fear negative consequences such as retrenchment and transfer of valuable technologies, etc. When the entering firm acquires a pre-existing organization, which had its own strategy, operations, and organizational culture, the firm faces integration challenges. However, because there are no co-owners of the subsidiary, the firm doesn't face any relational risk, that is, risks originating from the behavior of partners. Now let us see some examples of full acquisition. In 2007, the Indian firm Tata Steel entered the British and the European markets in a substantial way by acquiring Chorus Steel, which was much bigger than Tata. Similarly, in 2008, Tata Motors acquired Jaguar and Land Rover. In 2005, Lenovo acquired IBM's personal computer business. Lenovo gained not only access to the US market, but also reputation and technologies, boosting its global recognition and sales quite substantially. Now let us take the case of firm entry into a foreign market through joint venture with local firms. In this case, the entrant and the local partner together create a new organization in which both have ownership stakes. Both of them pool their resources and share costs, risks, and profits. Normally, the foreign firm brings in new technologies and product innovations, whereas the local partner brings in local knowledge and network. Thus, together, they expect to do well and have a competitive advantage over their rivals in this new market. Joint ventures are also politically more acceptable than acquisitions because the governments generally think that the domestic firms are learning new technology through such ventures. Now let us look at the disadvantages. First of all, the foreign entrant and the local partner may have divergent goals and interests, which can lead to conflicts and confusion. As the entrant has limited ownership and control, the subsidiary is often not well integrated with its global strategy and operations. Another big challenge of international joint venture is the race to learn among partners. Through the joint venture, the foreign entrant tries to generate local knowledge and network, whereas the local firm tries to learn about the technologies. Whoever achieves the learning objectives fast doesn't require the other anymore and may dissolve the venture. Thus, there is high relational risk and risk of unintended knowledge spillover to the partner. In future, the partners are also likely to become competitors. We have a lot of examples of it. Now, let us look at some examples of joint ventures. In 1993, Eli Lilly entered Indian market by creating a joint venture with Ranbaxy. It is a case of a successful international joint venture which Eli Lilly subsequently acquired without any bad blood between the two partners. There is another example. In 1996, Danone, the French food firm, entered China by creating a joint venture with Wahaha Group, which was a beverage firm, Chinese beverage firm. This joint venture finally dissolved with a lot of conflicts, allegations, counter-allegations, and legal actions. Now at the end, entry into a foreign market through partial acquisitions. In this case, the firm acquires a sizable stake, say more than 10%, in an existing foreign firm with an objective of influencing its strategy. As the previous owners are reluctant to sell all their stakes, it signals that the assets are of high quality, or at least the owners are still optimistic about the assets. The entrant enjoys continued commitment of the previous owners. However, the disadvantage of such ownership is firm's limited strategic and operational control over the subsidiary, especially when it is a minor shareholder. In case of partial acquisitions, the entrant is exposed to limited investment risks. However, it faces substantial integration challenges and high relational risk, that is, risk coming from the behavior of the co-owners. Let us see some examples. Japanese pharmaceutical firm Daiichi Sankyo entered the Indian market by acquiring majority stakes in the market leader Ranbaxy. Another example is Grab, which is a ride-hailing taxi service provider in Southeast Asia. Since 2018, Uber operates in these markets by owning stakes in Grab.